Hello, this is Bob Vensko, President of Regal Home Lending. We'd like to thank you all for joining us on our very first ever podcast, and we welcome you back every week with a new episode as we discuss changes in the mortgage industry and how that affects you as a consumer. The biggest takeaway that I want everyone to have from the show today is to keep in mind that there has never been a better time to work specifically with a broker. The reason being is that we're partnered up with dozens of different lenders, and they're all going through their own ups and downs independent of one another. So that means if you were to just go to your local bank, you get whatever they're serving that day. As a broker, we have the unique ability to see which lenders are having better days, and that reflects on the rate sheets and what we can provide you. So definitely let us do all the footwork for you to make sure that you're maximizing your total savings in this very volatile market. All right, let's start the show.
5, 4, 3, 2, 1, 0. All engine running. Liftoff. We have a liftoff.
So let's do a quick little recap of some of the major milestones that have happened over the past few weeks in the mortgage industry. So March starts out, coronavirus fears are starting to sweep over from European countries, and the Fed reacts to hopefully stabilize the U.S. markets and economy by doing a 50 basis point rate cut. And that did have temporary favorable impact to our mortgage bonds and mortgage rates, but it was very short term. So let's say first week of March, they do a 50 basis point rate cut. And then it was only a matter of about a week, and they dropped the floor all the way to 0 to a quarter on the Fed's funds rate. Now, you would think that that would mean that mortgage rates would improve drastically, but that only lasted for about 3.5 days. So if you were one of the lucky few who were able to jump on a refinance opportunity, you may have been looking at 2.75, 3%, no closing costs, and been able to lock that up. But what ended up happening over the next couple weeks from that point is that mortgage lenders started to get very nervous that they wouldn't be able to package all of their loans up when they go to turn around and sell them to Fannie Mae or Freddie Mac, because the bondholders that go to purchase those started to get really nervous. And you might ask yourself, well, what do they have to be nervous about? Well, as a bondholder, let's say for really low numbers, of course, this is in the millions, if not billions. When you go to purchase a bond, if you had a bond for $1 million, you're probably paying somewhere closer to $1,040,000, $1,050,000. It's going to take them a little bit of time to recoup some of their money. And if mortgage rates are dropping so drastically, they're worried about what's called a EPO, or early payoff, which means if rates were to drop for a consumer from 4% to 3.25%, there's a really good chance that you're going to take advantage of that yourself and refinance. Well, when you go to refinance, that bondholder is losing out a lot of money, usually in the millions. So they stopped buying bonds. They want to wait this out for a little bit and see once the market stabilizes. So from that point, bonds started just stacking up like a sink full of dirty dishes. Nobody wants to touch them because you don't even know where to start. So fast forward to the most recent week, and the Fed said, all right, we are going to do $60 billion in reserve management bond purchases, and we'll continue doing this through mid-April. Well, $60 billion started to improve the market, but they ended up having to up that to as much as $500 billion in new treasury purchases, plus $200 billion in mortgage-backed securities purchases. And then we started getting more so into quantitative easing. Now, what does all this mean for you? What this means is that the feds are trying to inject as much liquidity into the market as possible, so that way credit doesn't freeze up, because credit will freeze up for lenders if they can't sell their mortgages to the bondholders, which frees up their warehouse lines to be able to fund more new loans. So when they can't free up their warehouse lines, they have to pump the brakes. And what's the best way for them to pump the brakes is to offer unattractive interest rates, so that way nobody wants to give them new business. And that's exactly, going full circle, what we started to experience. Is we went from 2.75, 3%, just these phenomenal rates for about 3.5 days. And then it went up to 3.5, 3.75, 4, 5, 6. And that was pretty terrifying. With the Fed stepping in saying, you know what, with these various bond purchases, they've since came out and said, you know what, we will go ahead and purchase an unlimited amount of mortgage bonds. And this helped take out the massive inventory of bonds that were just stacking up. Problem number 2, servicing. The servicers have to pay back those bondholders no matter what. So with everybody getting laid off, many homeowners are not able to make their mortgage payment. So if you can't make your mortgage payment, that servicer still has to make your payment on behalf of you to the bondholder. And this is adding up to billions of dollars. Now, there was an article that I saw earlier this week that mentioned one servicer in particular who was receiving about $8 billion a month of mortgage payments, and they're anticipating 25 to 30% of those to go unpaid. So with that number, how long can they float it to make their payments to their bondholders before they freeze up? So this is kind of the consequence number 2 to what's happening in the markets right now in preventing mortgage rates to still drop down to where we all hope they would be. Now, don't get me wrong. We're still seeing a significant improvement. We're back into, I would say, mid to upper 3s on a 30-year, which is significantly better than where we were at a couple weeks ago. But once all this dust settles, we would absolutely love to be into the low 3s. So final takeaway for this topic is that the market is starting to stabilize, which is a great thing because it's giving lenders the confidence that they need in order to start lowering rates back down to where they need to be. Next topic that I want to talk about is forbearance. Essentially, you would fall into one of 2 categories. You're either a renter looking to purchase a home, or you're an existing homeowner who is either looking to refinance or maybe purchase a new home and move out of your old home. Equally, forbearance, whether it's forbearance of your rent to your landlord or forbearance of your existing mortgage, can have a detrimental effect on your credit, both in the short term, long term, and any kind of headaches down the road. Now, a lot of the questions that I've been getting from my clients is that, all right, well, I was either laid off or forced to not go into work, and I just can't make my mortgage or rent payment. And I totally understand. However, if you do have the ability to make your payment and it's not going to put you in a super bad position, I would recommend to try everything you possibly can to do that. The reason being, any small hit to your credit score can have negative consequences beyond the scope of a mortgage or your rental history. So let's kind of break this down. As a renter, when these guidelines are getting tighter, one of the things that lenders do to look at your stability as a borrower and your ability to repay is they look back at your rental history. So if they look at your rental history for the last 12 months, and it shows that you were in forbearance on your rent for 60, 90 days, That's not good. And that may prevent you from being able to get a house until those, I'll call them negative marks in your rental history have seasoned out past 12 months. And who knows if the guidelines will get even more strict due to this as the ripples start to smooth out. As a homeowner, when you request forbearance, don't just completely stop making your payments. You definitely need to set that up with your servicer in advance. There can be negative consequences for that as well. The federal government stepped in and said that they are not to be reporting a forbearance request as a derogatory on your personal credit. However, it's not to say that that's not going to slip through the cracks and cause you a world of headache to try and get that cleared up. I wouldn't doubt it if a lot of these creditors are going to go ahead and report it negatively as an oops. And it's up to you to turn around and try and get that fixed. All while the creditors are working with skeleton crews in their call centers, if they're even open at all. And in the meanwhile, your credit score is going to plummet 75, 100, 150 points. And it's up to you to fix it. They're not going to go out and fix it on their own. And this is going to have consequences in other aspects as well. A lot of people don't even realize that your homeowner's insurance, your car insurance, many other facets of your personal finances are tied to your credit score. So if your credit score is going down, being that you did a forbearance on your mortgage payment, you might see that your homeowner's insurance renewal shoots up $200-$300 next year, or your car insurance. And these are all repercussions that we're not planning on. Or let's say 2-3 months from now, everything's getting a little bit better, the economy is starting to pick back up, and rates are at 2.875, and you want to go ahead and take advantage of that. But you find out that those forbearances showed up as negatives, or that there's a new guideline that says, hey, even if you don't have a negative late payment on your credit report, if you requested a forbearance, we don't want to lend to you. You're a risk. So now that forbearance could have an impact on you from saving tens of thousands of dollars on a 30-year mortgage until that can season out, typically 12 months or more. So these are all things that you need to think about. I understand that it's not always going to be in your control, but these are questions that I'm hearing from my clients and just trying to give them as much information as possible so that way they can make an informed decision about their own personal finances. That's going to wrap things up for this episode. I want to thank everybody for joining me. Again, this is Bob Bensko, President of Regal Home Lending.